On March 15, 2020, something unprecedented happened in the history of American finance. The Federal Reserve announced they would purchase $700 billion in government bonds and mortgage-backed securities. But here's what they didn't tell you in the press release. That $700 billion was just the beginning. Over the next 2 years, the Federal Reserve would create $5 trillion out of thin air, expanding their balance sheet from $4 trillion to $9 trillion in the blink of an eye. Welcome to the Wealth Continuum, where we break down the financial moves that change everything. And what happened next changed the game for Bitcoin forever. But the story doesn't start in 2020. It starts with a problem so massive, so systemic, that it forced the world's most powerful financial institutions to do something they swore they would never do. Before we dive deeper, if you're watching from anywhere in the world, drop a comment and let me know where you're tuning in from. And if you want to stay ahead of what's really happening in global finance, hit that subscribe button right now, because what we're about to uncover explains why Bitcoin just became unavoidable for Wall Street, whether they like it or not. Let's talk about the elephant in the room. As of January 7th, 2026, the United States national debt sits at $38.43 trillion. That's not a typo. $38.43 trillion. To put that in perspective, just 1 year ago, the debt was $2.25 trillion lower. That means the country is adding debt at a rate of $8.03 billion per day, every single day. While you sleep, while you work, while you scroll through social media, the debt clock is ticking up $334.48 million per hour, $5.57 million per minute, $92,912 per second. Think about that for a moment. By the time you finish watching this video, several million more dollars will have been added to the national debt. But the real problem isn't just the size of the debt. It's what it costs to service that debt. Because money isn't free, even for governments. In 2025, the United States spent $1.22 trillion just on interest payments, not paying down the debt, not investing in infrastructure or education or defense, just interest. That's more than the entire GDP of most countries. And it's getting worse. By the end of 2025, interest costs were climbing at 13% year over year, hitting $92 billion per month by the final quarter. You print money. And that's exactly what happened in 2020. When the pandemic hit, the Federal Reserve didn't just lower interest rates to zero. They went full throttle with something called quantitative easing, or QE. Here's how it works in plain English. The Fed creates money digitally, not by physically printing it, but by adding zeros to bank reserve accounts. Then, they use that newly created money to buy government bonds from banks and financial institutions. This serves two purposes. First, it pushes bond prices up, which pushes interest rates down, making it cheaper for the government to borrow. Second, it floods the banking system with cash, theoretically encouraging banks to lend more and stimulate the economy. In March 2020, the Fed announced unlimited quantitative easing. Unlimited. They removed all caps and said they'd buy as much as needed. The result was that the money supply, measured by something called M2, exploded. In just 2 years, they created roughly $5 trillion in new money. To understand how extreme this was, consider that it took the Fed over a century to grow its balance sheet to $4 trillion. And in 24 months, they more than doubled it to $9 trillion. That's a monetary expansion on a scale never seen in peacetime history. Every economics textbook will tell you what happens next. When you drastically increase the money supply without a corresponding increase in goods and services, you get inflation. And sure enough, by 2021 and 2022, inflation was hitting levels not seen since the early 1980s. The purchasing power of your dollars started evaporating. Your groceries got more expensive, gas prices soared, housing costs went through the roof. The very act of trying to save the economy from a recession ended up destroying the value of the currency itself. But here's where it gets interesting. And while the Federal Reserve was creating trillions of dollars, a small group of people were watching and thinking about what this meant for the long term. They understood something fundamental. If the government's solution to every crisis is to print more money, and if the national debt is so large that it can never realistically be paid back, then holding cash becomes a losing game. You're essentially holding a melting ice cube. The question became, where do you put your wealth to protect it from currency debasement? Traditionally, the answer was gold. For thousands of years, gold has been the ultimate store of value. It can't be printed. It can't be debased. It's scarce. But gold has limitations in the modern world. It's hard to transport. It's difficult to divide. It's expensive to store securely. You can't easily send gold across the internet to settle a transaction. And that's where Bitcoin enters the story. Bitcoin was created in 2009, right after the last financial crisis, with a very specific design. There will only ever be 21 million Bitcoin. No government can change that. No central bank can print more. The supply is fixed forever by mathematics and code. In a world where central banks were proving they would print unlimited amounts of currency whenever faced with a crisis, Bitcoin represented something revolutionary. It was digital gold, but better. You could store it without needing a vault. You could send it anywhere in the world in minutes. You could verify its scarcity yourself. And perhaps most importantly, no government or institution controlled it. Now, for years, Wall Street dismissed Bitcoin. It was too volatile. It wasn't backed by anything. It was used by criminals. The mainstream financial establishment wanted nothing to do with it. But then, something shifted. It started with a company called MicroStrategy and a man named Michael Saylor. In August 2020, right in the middle of the Fed's money printing spree, MicroStrategy made a shocking announcement. They were going to convert their cash reserves into Bitcoin. This wasn't some small tech startup. This was a publicly traded company with a multi-billion-dollar market cap. On August 11th, 2020, MicroStrategy bought 21,454 Bitcoin for $250 million at an average price of $11,754 per coin. Wall Street thought they were crazy, but Saylor explained his reasoning very clearly. He saw cash as a melting ice cube. With the Fed creating trillions of dollars, the purchasing power of cash was guaranteed to decline. Bitcoin, on the other hand, had a fixed supply. If you believed the government would continue printing money, and if you believed more people would eventually recognize Bitcoin's scarcity value, then buying Bitcoin was the rational move. And MicroStrategy didn't stop there. They kept buying. In September 2020, another $175 million for 16,796 Bitcoin. In December, they issued convertible bonds to raise capital and bought 29,646 more Bitcoin. By the end of 2020, MicroStrategy held about 70,470 Bitcoin. Over the next few years, they continued accumulating. Through market crashes, through skepticism, through volatility, they kept buying. They raised capital by issuing debt and selling stock, then used that capital to buy more Bitcoin. By August 2025, exactly 5 years after their first purchase, MicroStrategy held over 628,900 Bitcoin valued at nearly $76 billion. That represented about 3% of all the Bitcoin that will ever exist. They had become the largest corporate holder of Bitcoin in the world. As of January 18th, 2020 statistics, their holdings had grown to 687,410 Bitcoin with a total cost basis of $33,139 billion, an average purchase price of $66,284 per coin. The MicroStrategy playbook sent shockwaves through corporate America. If a publicly traded company could put Bitcoin on its balance sheet and thrive, why couldn't others? And slowly, the dominoes started to fall. Tesla bought $1.5 billion worth of Bitcoin in early 2021. Square, now called Block, had been buying Bitcoin for their treasury since 2020. Companies in Japan like Metaplanet started copying the strategy. Semler Scientific in the United States followed suit. By 2025, over 70 public companies worldwide had adopted a Bitcoin treasury standard. But the real shift happened when Wall Street itself got involved. For years, the traditional finance giants had stayed on the sidelines. But in early 2024, something changed. The Securities and Exchange Commission approved spot Bitcoin ETFs. These weren't futures contracts or complicated derivatives. These were actual funds that held real Bitcoin, allowing institutional investors and everyday people to get Bitcoin exposure through their regular brokerage accounts without having to deal with wallets or private keys. And the response was explosive. BlackRock, the world's largest asset manager, launched the iShares Bitcoin Trust, ticker symbol IBIT. Within less than 1 year, it accumulated over $50 billion in assets under management. That made it the most successful ETF launch in history. To put that in perspective, gold ETFs took years to reach those kinds of numbers. Bitcoin did it in months. Fidelity launched their own Bitcoin ETF. ARK Invest joined the race. Major financial institutions that had spent years dismissing Bitcoin were now fighting for market share in Bitcoin products. The daily inflows were staggering. In the days following the 2024 election, Bitcoin ETFs saw record inflows of $1.38 billion in a single day. For all of 2025, total ETF inflows reached $6.96 billion. Institutional capital wasn't just dipping its toe in the water anymore, it was diving in headfirst. Here's what was happening behind the scenes. Pension funds, endowments, sovereign wealth funds, family offices, they were all waking up to the same realization. The debt problem wasn't going away. In fact, it was accelerating. And the only tool governments had to manage that debt was to keep interest rates low and print more money when needed. That created a serious problem for institutional investors. Where do you park trillions of dollars when bonds yield almost nothing after inflation? When cash is losing purchasing power? When traditional safe havens aren't so safe anymore? Bitcoin started looking less like a speculative gamble and more like a rational hedge against monetary debasement. But it wasn't just about the macro environment. There were structural changes happening in 2025 that made Bitcoin more accessible to institutions than ever before. On January 23rd, 2025, just 3 days after President Trump's second inauguration, the SEC repealed something called SAB 121. This was a regulatory bulletin that had effectively banned banks from offering cryptocurrency custody services. It forced banks to hold client crypto assets as liabilities on their balance sheet, making it economically impossible to offer those services. When SAB 121 was replaced with SAB 122, a risk-based framework, it opened the floodgates. Banks could now treat Bitcoin like any other asset. Custody solutions became available through traditional financial institutions. The infrastructure that institutions needed to safely hold Bitcoin at scale suddenly existed. Then, in March 2025, President Trump signed an executive order establishing something called the Strategic Bitcoin Reserve. The United States government formally designated over 200,000 Bitcoins seized from criminal activities as a national strategic asset. They weren't selling it anymore, they were holding it. If the US government itself was treating Bitcoin as a strategic reserve asset, what message did that send to the rest of the world? Other countries started paying attention. El Salvador had already made Bitcoin legal tender. Bhutan was accumulating Bitcoin through mining operations. Rumors circulated about other nations quietly building positions. Let's talk about what this means in practical terms. American retirement accounts hold over $43 trillion. Global institutional assets exceed $100 trillion. Until recently, Bitcoin existed in a regulatory gray area that kept this money on the sidelines. But as the regulatory environment cleared up and the infrastructure improved, a pathway opened. Industry analysts estimate that if just 2 to 3% of these institutional pools allocated to Bitcoin, that would represent $3 to $4 trillion in demand. Bitcoin's total market value today is around $2.2 trillion. You can do the math on what that kind of demand would do to the price. Fidelity introduced Bitcoin ETF options in select 401k plans. Companies focused on small business retirement plans started offering cryptocurrency investment options. Major providers like Schwab and Vanguard were evaluating Bitcoin ETF inclusion for retirement accounts. This wasn't a fringe movement anymore. This was the mainstream financial system integrating Bitcoin at the foundational level. But let's zoom out and connect all the dots. The $21 trillion problem we mentioned at the beginning isn't actually $21 trillion anymore. It's $38.43 trillion and climbing. Every year, the Congressional Budget Office projects higher and higher interest costs. Every year, the options for dealing with this debt become more limited. The political reality is that no one is going to make the hard choices necessary to actually pay down the debt. That would require massive spending cuts or tax increases that are political suicide. So the path forward is predictable. Keep borrowing. Keep refinancing the debt at whatever interest rate the market will bear. And when the next crisis hits, whether it's a recession or a war or a pandemic or a financial crisis, the response will be the same. Cut interest rates to zero and print money. That playbook has been tested twice now in the 21st century. Once in 2008 during the financial crisis, again in 2020 during the pandemic. Both times, the Fed's balance sheet exploded. Both times, they created trillions in new money, and there's no reason to think the next crisis will be handled any differently. This is the environment that's forcing Wall Street into Bitcoin. It's not about greed or speculation or trying to get rich quick. It's about survival. It's about preserving wealth in a system where the currency itself is being systematically debased. Think about it from the perspective of a major institution managing billions of dollars. You have a fiduciary duty to protect that capital. You look at the national debt trajectory. You look at the Fed's balance sheet. You look at the history of every fiat currency that's ever existed. And you realize that holding pure fiat long-term is a bet against thousands of years of monetary history. Every empire that debased its currency eventually suffered the consequences. Rome, Weimar Germany, Zimbabwe, Venezuela. The pattern repeats. The United States is different in many ways, and the dollar's reserve currency status buys time, but the laws of economics still apply. You can't print unlimited money forever without consequences, and institutions are starting to prepare for those consequences. That's why we're seeing this unprecedented shift. As of mid-2025, institutional investors control somewhere between 17 and 31% of Bitcoin's total supply when you include governments and ETFs. Entities like BlackRock's IBIT alone hold massive positions. MicroStrategy's 687 order 410. Bitcoin represents about 3.3% of all Bitcoin that will ever exist. Add in all the other public companies, all the ETFs, all the institutional holdings, and you're talking about a significant portion of the finite supply being locked up by entities that plan to hold long term. Here's where the supply dynamics get really interesting. Bitcoin has something called the halving. Every 4 years, the amount of new Bitcoin created gets cut in half. The next halving will happen in 2028. After that, miners will produce roughly 700,000 new Bitcoin between now and 2030. That's it. Meanwhile, demand is accelerating. More institutions are entering, more countries are accumulating, more companies are adopting the MicroStrategy Playbook, more ETFs are launching with more sophisticated products. What happens when you have fixed, declining supply and increasing institutional demand? The math isn't complicated. Price goes up. Some analysts project Bitcoin could reach $150,000 by the end of 2025. Michael Saylor, who's been proven right so far, has made long-term projections of Bitcoin eventually reaching into the millions per coin over decades. But let's address the risks. Bitcoin is still volatile. It's crashed 70% or more multiple times in its history. It could do that again. Governments could crack down with harsh regulations, though that seems less likely given that the US now holds Bitcoin as a strategic reserve. There could be technological risks we haven't foreseen. There could be competition from central bank digital currencies. These are all legitimate concerns. But institutions are weighing those risks against the certainty of currency debasement. They're looking at the choice between a volatile asset with fixed supply and a stable asset with infinite supply that is guaranteed to lose purchasing power. For an increasing number of sophisticated investors, that's not really a choice at all. Here's what most people don't understand about institutional money. Once it starts flowing into an asset class, it creates a self-reinforcing cycle. The more institutions that adopt Bitcoin, the more legitimate it becomes. The more legitimate it becomes, the easier it is for others to justify allocating to it. And as infrastructure improves, it opens the door for even larger pools of capital. We're watching this cycle play out in real time. The Bitcoin ETF approvals gave regulated access to the largest pools of capital in the world. In 2025, we saw Bitcoin ETFs with staking rewards, multi-asset crypto index ETFs, and ETFs powered by DeFi protocols generating yield. The product innovation is accelerating. Wall Street is building the financial products that turn Bitcoin from a speculative asset into a core portfolio holding. And this is happening at the exact same time that the debt crisis is getting worse, not better. The timing isn't coincidental. The two trends are directly related. The debt crisis is the problem. Bitcoin is emerging as part of the solution, at least for protecting wealth from the consequences of that crisis. Think about what happened with gold. For decades, central banks around the world held gold as part of their reserves, not because they expected to use it as currency, but because it was a hedge against their own currencies losing value. Bitcoin is increasingly being viewed through the same lens. It's digital gold with better properties for the internet age. You can verify its scarcity, you can transport it instantly. You can divide it into tiny fractions. You can custody it without needing physical vaults. For institutions operating in a digital world, those properties matter. Now let's talk about what this means for the average person. If you're watching this video, you're probably not managing billions of dollars in institutional capital. But the same logic applies. If the wealthy and sophisticated are moving capital into Bitcoin to protect against currency debasement, what does that tell you? It tells you the game has changed. The old playbook of just saving in cash and maybe buying some bonds does not work when your currency is losing 5, 7, 10% of its purchasing power every year to inflation. The question isn't whether Bitcoin is risky. Everything is risky. Cash is risky because of inflation. Bonds are risky because interest rates and inflation erode returns. Stocks are risky because markets crash. Real estate is risky because property values fluctuate and leverage can destroy you. The question is, what's the best way to preserve and grow purchasing power over the long term given what we know about monetary policy and government debt? An increasing number of people are concluding that some exposure to Bitcoin makes sense as part of a diversified strategy. Not putting everything into it, not betting the farm, but recognizing that in a world where governments will continue printing money to manage unpayable debts, having some wealth in an asset with mathematically enforced scarcity is prudent. Here's the part that should really make you think. The institutions getting into Bitcoin now aren't doing it because they love the technology or believe in decentralization or want to stick it to the banks. They're doing it because they've run the numbers and they see what's coming. They understand that the debt trajectory is unsustainable. They understand that the political system can't and won't make the hard choices to fix it. They understand that monetary debasement is the path of least resistance, and they're positioning accordingly. When BlackRock, the largest asset manager in the world with over $10 trillion under management, launches a Bitcoin product and sees $50 billion flow into it in less than a year, that's not speculation. That's institutional capital making a calculated bet on where the world is headed. When over 70 public companies put Bitcoin on their balance sheets, that's not a fad. That's a fundamental reassessment of what constitutes sound treasury management in an era of unlimited money printing. When the United States government itself designates Bitcoin as a strategic reserve asset, that's not an endorsement of speculation. That's recognition of Bitcoin's role in the future financial system. So, where does this leave us? The debt crisis forcing Wall Street into Bitcoin is far bigger than most people realize. U.S. debt has climbed to over $38 trillion, and the cost of servicing it is exploding. Interest alone hit $1.22 trillion in 2025 and is expected to rise even further. The Federal Reserve has already shown the pattern. During the pandemic, its balance sheet surged from $4 trillion to $9 trillion. And when the next crisis arrives, they'll likely expand it again. Default isn't politically possible, spending cuts are unrealistic, and tax hikes have limits. That leaves one solution: more money printing. And every time that happens, Bitcoin's core argument becomes stronger. The more dollars created, the more valuable true scarcity becomes. With only 21 million Bitcoin ever existing, institutions are increasingly viewing it as protection against endless debasement. We're now at a tipping point. Institutional adoption isn't a question anymore. It's already happening. Ownership is growing, regulations are improving, and the biggest financial players are building the infrastructure to support it. Bitcoin may still be volatile and crashes are possible, but what's different now is the scale of adoption. MicroStrategy was mocked when it bought Bitcoin in 2020 at around $11,000. Today, it holds hundreds of thousands of coins, and many others have followed. When BlackRock enters the space, that isn't retail hype. It's the establishment acknowledging Bitcoin's staying power. The bottom line is simple. The debt problem is real, currency debasement is real, and institutional movement into Bitcoin is real. These trends aren't reversing anytime soon. Bitcoin isn't perfect, but institutions are betting that mathematical scarcity is stronger than unlimited printing. The real question is, in a world where governments create trillions whenever crisis hits, where does your wealth stay safe long term? So, what do you think? Are institutions making the right move, or is this a massive mistake? Share your thoughts in the comments and subscribe to the Wealth Continuum for more breakdowns as this story unfolds.